chapter 7 is on audit planning, and I'll just indulge, I'll beg you guys to give me extra 15 minutes so that we can close it out quickly. Yes, please.
For our benefit.
Thank you so much. Yeah, thank you. Thank you.
Did
for
you
that.
put it in the group? Did you put it in the group that you're back? Let's see.
Yes, I did that.
Okay.
Yeah,
Okay.
I believe they will soon join back. Yeah. Okay, so we'll look at the audit plan based on the units in this short chapter, which is a strategy document. We're looking at the audit risk, we'll look at materiality, and we'll look at number 4, computers in auditing, and number 5, NGO audits and also public sector audits, and that will be it for this short chapter. So we're looking at the audit plan. What is an audit plan? An audit plan briefly is a document that is the blueprint for the auditor to achieve his objective. I'll say that again. What is an audit plan? It's the auditor's blueprint, a roadmap for achieving the auditor's objective. So to obtain reasonable assurance that the financial statements are free from material misstatements and errors, the audit plan is necessary to also report findings in line with ISA 200. So planning helps ensure the audit is effective, efficient, and timely. Very important. Take note of those verbs. The audit helps, or the audit planning helps ensure the audit is efficient, efficiency in terms of achieving audit objectives. Effective in achievement of audit objectives. The audit plan ensures the audit is effective, is efficient, it avoids unnecessary work, and is timely, it's completed within deadlines. Let me take that again. The audit plan or planning an audit helps ensure the audit is effective, which is effectiveness helps achieve audit objectives. Efficiency helps or avoids unnecessary work. And timeliness helps or looks at completeness or completing the work within deadline. So that's essentially what audit planning is all about. And to derive reasonable assurance that there are no material misstatements on the financial statements, there is need for a plan. So a plan is a decision in advance on what needs to be done to meet objectives with a deadline. So ISA 300 requirements on an audit plan is that a plan should be effective. It should effectively establish an overall strategy, which is the direction and supervision or review of the work. So generally, the audit plan is a very, very important document in any audit work. The planning of an audit of financial statements is like ISA 300, which is on planning of audit of financial statements, requires the auditor to develop a detailed plan, establish an overall strategy, like we've spoken to in chapter 6. Also look at including proper direction. The strategy should include direction, supervision, and review of the audit team. Planning is not a one-time event, so it's ongoing. It's not one-off. It continues throughout the auditing, and as new formation or information emerges, they need to update the plan. This is very important. So looking at the audit strategy memorandum or the audit plan, the document covers objectives, the timetable for the audit, the client's environment, and the changes that could be made, then maybe ratio calculations, planning decisions, the use of staff experts. Okay, so staff, your own staff or experts or specialists, you integrate that into the plan. The problem areas, the issue of staffing, location, and also communication during the audit should be embedded in the audit strategy memorandum. This is very, very important. The audit strategy memorandum, which is a plan document, is a core document which aligns or outlines the auditor's approach. It includes the auditor's objective and his scope. Like we said, the timetable of the phases of the audit, from planning to reporting phase, the key risk areas and business environment changes, the important planning ratios, which includes liquidity, gearing, profitability, investment, all the ratios that are necessary. The use of experts, specialists, internal audit work, or component auditors in terms of areas of group, the staffing and the team composition, which locations to be audited, the communication plan with management and those charged with governance are essential. Also, approval. It must be approved by the engagement partner before field work began. So the auditors need to get approval. The information for planning based on ISA 300 and 350 require understanding of the environment. After approval is gotten, you need to understand the environment the business is domiciled. Use judgment to gather relevant information on loan agreements, legal correspondence prior to the preparation of financial or the financial statements before us. So the information required, actually we're looking at the plan which is effective on the financial statements preparation and the plan on how to audit it. So the plan, the auditors have to gain a solid understanding of the client's business, which is very, very critical. You must gain an understanding of the client's environment, and it should be part of the plan. And also, the auditors should be able to understand the business environment, which includes the industry and the trends in that industry, the business structure and the operations of the business, laws and regulations that need to be complied with, internal and external. Also, key internal controls should be observed during planning, the financial performance and income statement and the position statement also is very important. So useful sources like previous financial statements, management accounts, legal letters, loan agreements, minutes of meetings of the board, and must avoid collecting immaterial or non-operational data. So we focus on what impacts the audit work very, very expressly. This is very important. So that's a short introduction on the audit plan. So let's look at the audit risk. If we don't have any question on the audit plan, let's look at audit risk. We are avoiding immaterial information, so the risk must be risk-based. The audit must be risk-based. So you need to identify and respond to business risk, the risk that are greatest, that bedevils the company or are threatening the company, which is in ISA 330. So audit risk looks at the model on the inherent and the control and the detection risk, which aims to reduce the audit risk strategically or significantly. So what is audit risk? Audit risk, we are looking at the risk that there are material misstatements that may go unnoticed in the financial statements, and it looks at inherent risk, and we want to bring the audit risk to a low or barest minimum. So the inherent risk look at susceptibility of an account or assertion to a misstatement. So for example, complex estimates, IS 37, cash transaction that may have inherent risk within them. So the susceptibility and vulnerability of an account or an assertion to a misstatement is what an inherent risk speaks to. Then a control risk speaks to statements or misstatements that are not prevented or detected by internal control. So those are control risks. So I take that again, risk that misstatements are not prevented or detected by internal controls. So those are control risks. Also, detection risks are the risk that the auditor's audit procedures will fail to detect any misstatements. So the inherent risk multiplied by the control risk multiplied by the detection risk culminates in the audit risk. And we need to keep them very low by adjusting or testing based on inherent and control risks assessment. This is very important. So inherent risk in practice assesses two levels. the financial statement level, we're looking at going concern issues. What will stop the company from operating in perpetuity or in the future? And you also look at the account or transactions level, judgments like provisions and day-to-day posting. So, for example, a company is delaying equipment replacement due to maybe funding issues, cash flow problems, will raises inherent risks due to valuation concerns, future operating risks, and inherent risk could be centrally focused or speak to that very practically. So inherent risk is a risk of misstatement due to the nature of items or the entity or the industry that business is domiciled. So access to the financial statements and account balance transactions, cash flow difficulties leading to deferred equipment replacement, like I stated, could be an inherent risk or an inherent risk challenge. So this is very important. So that's briefly on audit risk. Let's look at materiality on Unit 3, materiality. If you have any questions, please feel free to interject. We're trying to run so that we can get the time.
You're running so fast. You're running so fast. I could hardly grab the control risk, inherent risk. I could hardly grab it.
Apologies. Okay, so let me go back. I'm trying to run because of time. Please stop me. Please stop me. Don't mind me. I'm running because of time. Please don't mind me.
Because when you come and ask us for inherent risk, control risk, I will just be moping. I will answer it. So
I understand.
Inherent risk. What's inherent? Where do you inherit risk? All these risks, I could not even grab anything.
Okay.
Risk go.
So let me go back. Let me go back. Apologies. Okay. So inherent risk. Yes. So let's go back to inherent risk. Inherent risk, I said, the vulnerability or susceptibility of an account or an assertion leading to a misstatement. So you're looking at how vulnerable an account is, or a transaction or an assertion by management that is wrong. That's what we are looking at. So, for example, an accounting estimate, maybe you depreciated or estimated to depreciate asset by 10%, and that 10% is high or not sufficient enough. So maybe for computer equipment, we are supposed to depreciate at 5%, you make it 10%. So those are inherent risks that could affect the value of transactions in the financial statement. So we're looking at vulnerability now, and based on those assertions, are they correct based on current realities? So like cash transactions, what is the risk that it was inflated or is correctly posted as cash and cash equivalent? So those are examples of inherent risk, and generally speaks to vulnerability, susceptibility of an account or assertion to a misstatement generally. Then I said control risk are misstatements that are not prevented or detected by internal controls. So when you hear control risk, your mind should go to the internal controls. Something may go wrong with the controls, and the risk of those controls not working properly, efficiently and effectively is what control risk speaks to. Then detection risk is that as we are performing the audit procedure, substantive compliance testing may fail to detect a misstatement. So these three risks, inherent, vulnerability, control, detection by internal controls, then detection, the procedures may fail to detect the misstatements, are what culminate, if you multiply three of them, into audit risk. And the audit risk speaks to a risk that material misstatements or errors may go unnoticed by the auditor. So overall, this audit risk in our assessment should be kept low. It should be kept low to the barest minimum by answering questions of inherent risk, assessing their impact and likelihood, control risk, assessing their impact and likelihood, and the detection risk, assessing their impact and likelihood. They are technical terms and in practice, it's understandable, but for exam-prone candidates, you may struggle to understand its application and the concepts very, very graphically. But then I believe you're able to catch one or two thoughts on what I said.
Yes, sir. Yes, sir.
Okay. So you may need to go back to it and look at it very critically. Okay, so I also spoke about inherent risk. I said the auditors assess inherent risk at two levels. So inherent risk looks at financial statement level. The first level is financial statement level. From that financial statement, can the business operate in perpetuity? Does it have going concern issues? Going concern issues look at profitability of the business. Are they making losses concurrently year on, year out? Then the transactions, are the judgments on those provisions like depreciation flawed? So for example, an equipment needs to be replaced, but they don't have money to replace it. So future operating risk, valuation risk of assets. So those are inherent risks that could be devil a company. And I gave you two examples of the financial statement level and the transactions level. Okay, so let's look at materiality. And the definition includes influences. The materiality influences economic decision of users, looking at the size and the nature or the amount of items on the financial statement. So judgment depends on size and nature of the misstatement. What is the size? What 10 naira would do, and the 10 naira transaction and the 10 million transaction depends on the size of the organization and the users of the information. So in measuring materiality, there are thresholds. It could be percentage of revenue, percentage of profit, but we need to consider, aside these two factors, other factors. So materiality concept based on ISA 320 is central to audit planning and evaluation. It helps determine which areas to focus on. It helps us determine also the level of errors that matter, and also what we should report to management. So materiality is very central. And the key concepts include material misstatements that could influence users, the owners of the company or users' economic decision. And also performance materiality, we're looking at a lower threshold to reduce risk that aggregate uncorrected misstatements exceeded or that exceeds overall materiality. So the key concepts of materiality look at misstatements that will affect our judgment or the users of the financial statements decision. And also performance materiality looks at a lower threshold to reduce this risk and aggregate it with uncorrected statements that exceeds the overall materiality. And we can also revise materiality levels by changing if new significant information comes in during the audit. So common benchmarks could be maybe 0.5 to 1% of revenue could be our materiality threshold. So if revenue for the year is 1 billion, you look at 1% of 1 billion as a material transaction to focus on, or maybe 5% to 10% of profit before tax. Any transaction within that benchmark or threshold would naturally trigger our attention or capture our attention. Or 1% to 2% of total assets could be a benchmark. Yes, please. Julie, thank you very much. Please go ahead.
The materiality, is it just per transaction or the cumulative, the total? When you have to, when the auditor would think there's a problem, is it for one transaction that you have maybe like 1%, or for the whole audit?
Thank you very much for that question. Okay, so for the materiality threshold, so for example, in a year, you do revenue of, let's take it for example, 100 million. So from January to December, the whole transaction for revenue culminated in 100 million. Now, this materiality works by saying, out of that 100 million, if there is a transaction that is 1%, what is 1% of 100 million?
And that's the question I was asking. Is it proper transaction?
Yes. So what is the whole? the whole thing. So for revenue for a whole year, we are looking at 100 million as your revenue. So 1% of your revenue, management may say, okay, that's our materiality threshold. So 1% of 100 million is 1 million. So any particular transaction that is shady, that is 1 million, above 1 million, must be verified. That is what materiality talks about. So any standalone or specific transaction that says this is 1 million, and there are no controls or evidences of that 1 million, then the auditors will take note of that transaction. And that's what materiality speaks to. So for example, you give us a materiality threshold, or the auditor set a materiality threshold of 1% on revenue, and they see a cash balance of 1 million, and there's no evidence that that 1 million cash is in the bank or is at hand. Auditors have to take note of it. So they will call for petty cash reviews. You said you have 1 million as cash. Where is it? So you can see 1% of revenue is the threshold, but if you've found it in any item of accounts or any journal that is shady, that does not have any evidence, supporting evidence, you need to query it and bring to the attention of management that, okay, there is a transaction here above 1 million. And we don't understand how it came about, the posting, its classification. So you need to call management attention to it. So that's what materiality generally speaks to with that example. I hope you get it.
Yeah. So now it's transaction per transaction, not the total. Because let's say there are 20 transactions and the materiality is 1 million naira. So if each transaction has of maybe like it's 700,000. That means they will not put an eye on it.
Exactly.
So by the time you add up everything, it's going to be more than the 1 billion.
Yes, exactly. So
it's not very effective, you ask me.
Yeah, it's not very effective. Yes, please go ahead.
Because if it's transaction by transaction, then it's not worth. But if it's the whole thing, after everything, the whole thing, the materiality for this audit should not be more than 1 million, but not each transaction, because once you do each transaction, that will be total. Let's say 20 transactions, and there's a difference of maybe 700,000 for one, and you ignore it because it does not reach the materiality threshold. 700,000 times 20 is what? It's a lot of money.
So what we are saying is we are not ignoring it if it's below materiality threshold. Even if it's 1 naira, you must still audit it. But what we are saying materiality threshold is to call the attention of the owners to it, and also detect and also report anything above that. So anything below does not mean, let's let it go since it's below materiality. No, you won't let it go. So you may not escalate beyond the materiality level, but then you need to resolve it. Even if it's 1 naira you have doubts over, you must resolve it as an auditor. You won't say because it's below materiality threshold that let's leave it and let it go. No, you must resolve it and also call management attention. But when we talk of escalation, flagging, we are talking of material amounts that are above that 700 or maybe 1 million. Man, those amounts have to be escalated. If they are not resolved, you need to bring management's attention to it. Even below the materiality threshold, you bring their attention to it. But then the rate and the voice of flagging is what we are talking about. That of materiality will be loud, then that of maybe immaterial will be low, but you must still document it and bring it to the attention of management. So we are not saying ignore. So like you said, I like your example, 700 transactions times 20 is material, not that it's 1 by 1. So even if it's 1 or half, any immaterial issue you find in audit must be escalated, just depending on the voice and how loud it is. So the concentration is what we are speaking to, and that's the benchmark of, okay, these levels of percentages. If it is this high, call our attention to it. If it's not too high, resolve it with management. If management doesn't resolve it, still call our attention to it. And that's what the materiality concept generally speaks to. I believe it's a bit clear, right?
Yeah, it is.
Okay.
But okay. I don't agree with it too.
You still don't what?
Materiality concept, because I was reading something about it, like there's a question in November 2024, and that asks about materiality. That's question 1. In fact, I was even trying to extract a question while we're discussing. It's really not clear, really, because in this question they just gave that, okay, the materiality was initially determined at so amount, and then it was now revisited, or the auditor revised it, and it became lower. So my own question is it that every company has their threshold set, like internally, like is it part of the manual of the company, or there's a standard?
Okay, so there's yes, I get your question. So the answer is no, there's no standard. It depends on management's decision. So, for example, management will come and tell auditors that, okay, this is what we want you to concentrate on. This is a threshold. Maybe 10% of revenue should be the materiality threshold. And now, most at times in practice, you find out even management does not have the materiality threshold. The auditors set it. So the auditors set it based on the size, the nature of the business, and the materiality, the performance materiality used. So most auditors can just come and say 10% of revenue based on the assessment of the business. So after they looked at internal, external environment of the business, the nature of the financial statements, their performance, their position, they can determine the size. So in answering your question, there's no standard, there's no manual or policy. So the auditors mostly determine it. But when management or the board say, okay, we want you to concentrate on this, that is a special request. And that materiality is concentrated based on management. But in reality, what the Big Four do is they have their own threshold to address audit risk, inherent control, and detection. So in that question, November 2014, I've seen that question. Now, based on the audit that was going on, they had to adjust it up or down because of what they found out in the financial statements. Yes, exactly. So materiality is not set as a strict hard and fast rule. It could be adjusted. That is why we say it's not one-off, it's ongoing. As the audit is ongoing, you can adjust it up or down depending on your findings during the audit. That's a valuable question. Thank you for bringing that to the fore.
Thanks, sir.
Yeah, so Julie, we'll still look at that in one of our practice questions. Practically, if we look at a question, we'll understand the concept very well than just the theoretical aspect. So don't worry, we'll look at some questions and you'll understand it in practice better. So don't get confused. I believe it will be clear.
This topic is very confusing. I won't lie to you. It's not not the touch. It's not touching very well. I know. And I'm not even speaking. I'm not even speaking, but I think it's not just. I'm
telling you, because I was even reading, and when I was trying to do that question, I didn't even know what I was doing. Then I went to the answer thing, and then I was like, "What is this?"
You know, some of these questions and they are actually in practice. If you are in practice, maybe you work in an audit firm or you're an internal auditor like me, you understand the perspective. But if you are in business, maybe you are working in finance, you may not understand this because you are being audited. So none of you are in an audit firm, so you may not understand its practicality. That's the challenge. But don't worry, when we look at one of those questions, we'll shed more light on this. So just understand the theory that, okay, it's a threshold set based on either revenue, profit before tax or after tax, and it could be changed during the audit work as it's going on. Yeah, so just understand that. So when a practical question comes, we'll see how it will sink in. Don't worry, it will sink in. I promise you, it will sink in. All right. So let's run unit 4. Let's look at computers in auditing. Let's run through and see computers in auditing. Our computers have come to stay in our audit work, and we have no choice than to use them. Gone are the days when manual work is done. You sit down and be using your biro and all those big those books to balance your account. Computers have come to impart auditors' work, and the use of computer and the clients-based systems, computer-based systems have come to stay. The auditor using computers, laptops for admin, planning work papers, analytics is what is in vogue currently. Even sampling are done through Excel and other system-based resources. So it also enables remote review. You don't have to be there physically. You can use your computer, your connections to access data from clients. The need for controls in terms of confidentiality, data loss, audit trail, program operation is very important. So the client's computer system is essential, and we have general controls looking at the IT environment, development changes, trying to ensure that there are no unauthorized access to data, and also incorrect programs or data amendments or business continuity issues, crashes that could affect this data. So auditors need to review these general client controls. Very important. So we are speaking to the impact of computers. And in both the auditors' tools and the client systems, computers have come to revolutionized auditing. Don't mind my pronunciation of that word. The revolution in computers these days have gone haywire. Everything is computerized now, and businesses and organizations increasingly adopt computerized systems. Auditors are leveraging technology to enhance our efficiency and effectiveness in audits. So we use computers, rely on laptops, like I said, for such tasks of administration and reducing all the cumbersome wahala with papers. So this enables us work remotely. It enhances the highest standards of documentation and saving of large data sets that can maybe practically impossible to save with hard copy papers. So client computers help us evaluate and review the client's IT infrastructure to also assess related data to ensure their integrity, confidentiality, and reliability of the preparation of those financial statements. So we're speaking to general controls now. We're saying that the controls around the IT environment, system development changes, access control, business continuity. So our role is to review these general IT controls to ensure that they are working and reliable. Also, application controls, so specific controls that have to do with areas like inventory, payroll. So we need to focus on the completeness and testing this completeness to ensure they are accurate. So processing checks, master file controls, auditors reviews. We review and test this file to ensure that, or test these areas to ensure that they are working and they are correctly adequate in line with the information given to us. So we need to test and verify that application and general controls are correct materially. Also, the control, the COBIT that looks at the control and business objectives of IT and the frameworks around the IT controls used by IT professionals, those in charge of that unit in the business, and the management, and also the IT auditors. We have IS auditors, internal auditors for larger organizations, and how they manage data. The exchange of such data is EDI, electronic data interchange, looking at transmission of business data between your unit and others. So our concerns as auditors is lack of paper trail. So there needs to be a trail based on the transactions or what has happened, postings on the ERPs or the softwares a company is using, dependency on these systems, where there are lost or corrupted data, are there security, are there backups, the needs for control for transmission, output, viruses, and all these issues that bedevil digital computing, access to data. We need to take note of that during our audit work. So the electronic data interchange, transmission of business data, EDI helps us to be more efficient. So we need to be careful that these controls are secured and the security in place to protect this data during transmission, like having antivirus, firewalls to protect them. We need to assess this. We need to check that these things are in place, and also implement contingency plans for data loss and other issues that could come upon the client. Very important. So we also have computer-assisted audit techniques. We use computers by auditors. We use it to gather evidence necessary for complex systems and also verify or track audit trails. So the use of CATs enable auditors to use computer tools to enhance audit processes, especially dealing with complex systems without traditional audit trails. These tools help auditors gather and evaluate evidence more efficiently and effectively. We have audit softwares like IDEA, we have ACL, for example. They help us to extract and analyze client data like account balances, aged receivables, ratio calculations. They could be automated. They even help us to test data, sample transactions. Some of these computer-assisted techniques are embedded in the audit facilities. So the functions built into the client system to help us monitor transactions real time. So the advantages of the computer-assisted audit techniques are efficiency, allow us to work on large data sets that we may not practically manually be able to cover due to the sample size. They also help us be accurate. Those are advantages of computer-assisted techniques. So it helps us test data also widely, and the accuracy of these programs also are advantages of computer-assisted techniques, and also cost effectiveness. It reduces time spent on manual calculation and checking. So this saves costs both for the auditor and the client. Disadvantage of computer-assisted audit techniques: some are high in cost. Training your staff to also know how to use them is high, especially for small or less technical audit firms. So client dependence, client system interdependence also is a disadvantage, because computer-assisted audit techniques require integration with the client's system or his ERP, and it may cause operational delays or issues. Also, another disadvantage is ongoing maintenance. So you regularly need to update the software and the methods used, and also keep up with latest advancement. So in summary, computers have really helped influence audit processes by enabling auditors to perform remote reviews using advanced tools and ensure that the IT environment is secure and reliable. So we need to focus as auditors on IT controls and specific application controls, understand the COBIT for effective IT governance, and also the EDI systems, electronic data change, and leverage also computer-assisted techniques to streamline audit processes and also balance cost with operation. So generally, auditors must stay informed and adaptable to technologies, learn them, be tech savvy, and as times continue to evolve, ensure that tools and techniques remain effective in detecting and preventing financial misstatements. That's generally what this is all about. So, having spoken to the advantages, disadvantages, the limitations of computers in auditing, we need to run. We are in the last unit. Any questions on computers in auditing? I believe it's clear.
It was clear. How can it be clear? Computers in auditing. Clear. It was confusing. It was so technical. How can somebody think in all this? How can someone think in all this? I didn't get one single thing.
No, you take your time and go back to it. Don't worry, I understand. Take your time and go back to it. Go through the video again. We'll still look at questions. Why we are running this? Because of time. So don't worry, go back to it.
Yes, I understand. Yes, when you look at questions, as you said, one will understand it better.
Exactly. That was humorous, very humorous.
That's like
You know, I love being tech savvy. So maybe I was using my own self that I understand this thing. I didn't know I was I was communicating to those that don't understand at all. I'm telling you, I was enjoying the speaking English, Abi.
Because you just knew what you.
Well, I understand.
But Aisha, did you catch one or two things?
Yes, actually I did. But we'll visit the video again.
Yes, so please let's visit the video, and some questions actually come through that area. So as we are practicing, I believe we'll catch the concept more.
Yeah.
Okay.
Yeah. Okay, so let's run to the final unit, and we're looking at not-for-profit organizations audit or public sector audits. So what's the objective of auditing NGOs? Is to provide service. Okay, what's the objective of NGOs? Sorry, NGOs are to provide service and not profit. So the audit similarities look at overall structure like commercial audits, and commercial companies or general companies want their aim or objective is to make profit. So the key difference is in auditing or looking at NGOs, we're looking at regulations, the focus on services and delivery with resources and not profit. So in approaching NGO audits, planning, we need to consider the objective of the business. What are the regulations surrounding that industry, which is NGOs, the environment and the financial statement report format, and what are the risks of material restatement. So the risk, we assess inherent risk, looking at susceptibility and vulnerability. We look at control risk, for example, cash controls. Remember, we talk about money laundering and the issue with cash movements in NGOs, and also detection risk, the risk that we will not detect material misstatements in these NGOs or this report. So it's very important that the objective of NGOs actually is not to generate profit, but to provide service or achieve a specific social or charitable objective. So their activities typically focus on community welfare, education, health, or other causes that benefit society. So NGOs do not operate with a profit motive. We understand that. And the audit process shares similarities with commercial audits, actually. So for whether commercial audits or NGO audits, both types of audit, we aim to ensure financial accuracy and integrity of the financial statements that have been produced. So the audit approach for both, we focus on internal controls around the NGOs, we focus on accounting records, and also risk management. So for the internal controls, we look at segregation of duties, which is difficult in small NGOs actually. Authorizations, where there may be overrides, the cash recognition, income, use of funds. And there's also the internal controls around getting audit evidence, substantive testing likely, we focus on completeness, and audit evidence around misuse of funds. So these are generally the internal control issues with NGOs. And analytical procedures may need to be performed to review the financial statements. They're also reporting, we're looking at the standard report if legally required or otherwise based on ISA 700 structure. So generally looking at NGOs, regulations around the audit are very important. We look at specific regulations like requirements of these foundations, their laws. Hey, where did you guys lost my thoughts? Where were we?
Where were we?
Yes, please remind me.
About NGOs not filing financial statements because they are not profit-making organization. At least that's what I remember.
Okay, thank you for that. So we're looking at, well, I was speaking to the fact that their NGOs may have issues with internal controls and the difficulty with segregation of duties, looking at internal controls like authorizations, cash, income, and the use of funds. They may have internal control issues around this. And also audit evidence, we're looking at substantive testing like focusing on completeness and the misuse of funds. generally. So we may need to perform analytical procedures, substantive testing on the financial statements, also the reporting of the NGO FS, their standard report, if it's legally required, based on ISA 700 structure. So we're generally speaking to the controls that produces the financial statements, and the regulations of NGO are subject to specific regulations or legal requirements based on types of the NGO or the foundation. So these regulations may govern the tax exemption status of the NGOs. Some NGOs are tax exempt, or they are exempted from tax. The donor restrictions also of such NGOs must be taken into cognizance when we are performing the audits, and also reporting based on the requirements of those NGOs are very important. So that generally service delivery focus, the audit of an NGO focuses on ensuring that the organization is using its resources effectively to fulfill its mission. That's generally our aim, and not to maximize profit. So in their financial reporting, we typically follow unique standards such as maybe the US, but here we gravitate towards the UK kind of IFRS preparation, and we need to ensure that that is followed based on what NGOs report. So generally, in our approach to auditing them, we have to be objective, look at regulations, look at the environment of the NGO and the financial statement reports and the format, and also assess risks based on the inherent control detection risks, look at internal controls, and also obtain evidence after we've substantively tested the transaction. We focus on material areas that could impact decision making. It's very important to understand, based on the NGOs, that other factors like income, cash, in performing analytical procedures, we need to restrict funds. Also, sensitivity to admin costs are very important in NGO audits. So generally speaking, NGO audits are not too different from commercial audits, but then we need to consider considerations like cash significance, income risk, the inflow of and outflow of funds from donors, and the limitations of our scope. Restricted funds also, issues of money laundering, we have to be careful, sensitivity to administrative costs. So in summary, auditing NGOs involves understanding the unique financial and operational challenges faced by these NGOs. So the focus on ensuring that funds are used based on the mission and internal controls are in place to prevent fraud and abuse, and the financial reporting of the statement is transparent in compliance with relevant regulations. So we must keep, as auditors, our procedures to address complexities of fund management and the specific risks associated with the NGO sector. This is very important. So finally, let's look at public sector audit, and we'll close, taking so much time. Now, what are the principles of public sector audit based on ISA standard? The key difference are nature of the entity. For example, the Supreme Audit Institution, SAIs, government entities follow auditing public sector standards, which are IPSAS, and they follow ESIS, INTOSIS, QUANGOS. Let me give us the acronyms for these powerful bodies and their regulations. So we were looking at public sector audits, and the Supreme Audits looked at INTOSIS. INTOSIS are International Organization of Supreme Audit Institutions. So they are in charge of or provide regulations on public sector audits. So Supreme Audit Institutions includes ministries, government entities, state-owned enterprises, and their role is crucial in ensuring the use of public resources and compliance by government agencies. So the QUANGOS speak to QUISI, autonomous non-governmental organizations. So those are QUANGOS. They may follow international standards on auditing or they may not follow them. But IPSAS, International Public Sector Accounting Standards, are generally what these government or public sector audits follow. So the Quangos, the QC, anonymous, autonomous non-governmental organizations receive public funds not directly from government, but these bodies operate with a degree of independence but still have government oversight. So generally, they are partially independent, but they are fully subject to auditing standards as government organizations. So generally, public sector audits have the same basic auditing principles as other sectors, but focus on public accountability generally, regulatory compliance, and meticulous and judicious use of public funds. So the role of the Supreme Audit Institution is critical in overseeing public sector spending, and it's very essential to follow audit standards based on their level of dependence or their level of interdependence. So this is very important, and public sector audits are not exempted from following general or international standards on auditing substantially. So that's a quick look at NGOs and public sector audits. We've looked at how to describe an audit plan and audit engagement, the various components of audit risk, IR, CR, and DR, the principles and application of materiality, even there is a bit unclear, or to be clear as we go on. Also articulating the relevance of computers to auditing, especially computer-assisted auditing techniques that you feel is a bit technical. You should be able to at least grasp one or two things, even though not fully comprehensive. We'll still understand them as we go on with past questions. So that's it shortly. We have taken so much time. Let's run through our quiz and shut down for the day. Okay, so are we ready? I hope we've not dozed off.
No.
Have we?
No, I'm trying.
You are trying, but yeah, you've tried actually. Is Aisha still awake? Aisha, are you there? It's like Aisha has gone on voice. Aisha has taken off. Aisha, you are muted. You are muted if you are speaking. Are you there? It's already 10:41. She has tried, Jai. Okay, let's look at the quiz quickly, and let's start with Jay. Maybe she'll wake up and join us. All right, so number one, which of the following? So which of the following would be included in an audit planning memorandum? Job timetable 1, last year's management letter 2, 3, this year's written representation letter, and 4, this year's draft financial statements. Which of the following will be included in an audit planning memorandum? So A is 1, 2, and 3. B is 1, 3, and 4. C is 2, 3, and 4. D is 1, 2, and 4. Which of the following will be included in an audit planning memorandum?
Wait.
Are you awake? Are you there, A? Trying to wake her. Maybe she's... so which of the following will be included in an audit planning memorandum?
Okay. 1, 3, B.
1, 3, and 4. Final answer B. All right. Number 2. In addition to the traditional benchmarks for materiality, see question. What other issues should be considered in relation to materiality? A. Degree of approximation, critical points, offset and aggregation, director's responsibilities. B, offset and aggregation, critical points, degree of approximation, losses, or low profits. C, director's responsibilities, critical points, losses or low points, degree of approximation. D, degree of approximation, director's responsibilities, offset and aggregation, losses or low profits. In addition to the traditional benchmarks for materiality, what other issues should be considered in relation to materiality? Tricky question though.
Okay. Okay.
Right, a tricky one.
Come in. A.
All right, degree of approximation, critical points, offset and aggregation, director's responsibilities. Okay, we'll see.
Hang on. Sorry, let's go back. Sorry.
Okay.
Come in.
Hey, are you there? Hey, are you there? You are muted.
It's okay. It's okay. It's okay.
Okay.
It's fine.
All right, a final answer. All right, let's go. Number 3. In the context of audit planning, financial statement risks consist of A, control risk and detection risk, B, business risk and audit risk, C, inherent risk and control risk, D, detection risk and business risk. In the context of audit planning, financial statement risk consist of audit control and detection, business and audit, inherent and control, detection and business. Which one? Financial statement risk.
It's C.
Inherent and control, C. Okay. Final answer, C. C.
Mm.
Right, number 4. Internal controls relating to the way in which IT systems are developed and operated are known as development controls, general controls, embedded controls, application controls. Internal controls related to the way in which IT systems are developed and operated are known as development controls, general controls, embedded controls, and application controls.
Embedded controls. Application controls. Yeah.
So C or D? Which one? Internal controls.
Application controls. D.
Okay. Okay. Final answer, D. All right, final for the night. The 2 common categories of computer-assisted audit techniques. See the area again, she was having challenges. The 2 common categories of computer-assisted audit techniques.
I had to challenge in all of them, so.
Yeah, you still go back to them and you resolve those challenges. So A, audit data and test solutions. B, bespoke systems and test data. Proprietary control software and checksums. D, audit software and test data. The 2 common categories of computer-assisted audit techniques are audit data and test solutions, bespoke system and test data, proprietary control software and checksums, audit software and test data.
2 common categories of computer-assisted.
Two common categories of computer-assisted audit techniques are audit data and test solutions, bespoke system and test data, proprietary control software and checksums, audit software and test data.
Coming on. Audit software and test data. No. Stop that. D. Computer assisted audit. I'm coming.
Two common categories of CAT includes audit data and test solution, bespoke system and test data, priority control software and checksums.
Let me do A. A is okay. A.
Not D. Not D.
A.
Final answer, D or A?
A.
Okay, final answer. All right, D. So let's go. Judgment D. Number 1. D. So what's the question? Which of the following will be included in an audit plan memorandum? So the answer is D. 1, 2, and 4. So we include the job timetable, we include last year's management letter, and we include this year's draft financial statements. So
last year's management letter?
Yes. So the management letter speaks to the, so we are speaking to the fact that this is what we did last year, and this year we are updating it based on current reality. So we're using 1, 2, and 4. So you pick B. We can include the written representation letter. That happens during the audit work, so you can include it in your plan. So take note of that. D is the correct answer.
Okay.
So you have done one giveaway. So the audit plan memorandum is prepared before detailed audit begins. It cannot contain this year's letter of representation, yes, which will not be prepared until near the end of the audit process. So generally the management representation letter is prepared during the audit work, not during the plan. Take note of that. Number 2, B. Another giveaway again. B.
I just I don't feel everything now. I'm sure I've failed everything. I'm sure I had 0. I'm sure I had 0.
Choose A. So, in addition to the traditional benchmarks for materiality, what other issues should be considered in relation to materiality? So it's offset and aggregation, critical points, degree of approximation comes third, and losses or low profit. So under exam condition, if you write them not in any order, you get your marks. But this is because it's OBJ, so don't worry and don't disturb yourself. As long as you write it based on the content, they capture everything during the exam condition, you're fine. So that's number 2 giveaway you did for me. So director's responsibilities have little to do with materiality. Exactly. Then number 3, you got it. C. So financial statement risk control, you got it now.
Okay,
consists of risk. Control risk. So these are the risk of material misstatements in the financial statements if not detected by the auditor. So audit risk is determined by financial statement risk and detection risk. You got C. And number 4, you did give away, which is B. So what's the number 4? Internal controls relating to the way in which IT systems are developed and operated are known as general controls. The answer is not application. So you decided to do giveaway. And finally, the answer is D. Another giveaway.
That's 20%.
I was even asking you, I said, are you sure D or B? I was trying to give you a clue because audit software is a computer assisted technique and test data, but you just changed it and went for audit data. Test solution is not a computer. And you said it, you said audit software. But during the class, we were speaking to CAT, audit software, test data. You chose D. When you now decide to go for A, I said, all right, you are not sure.
That's 20%. I even tried to. I thought I'm going to get 0 in everything because this particular session was not, it didn't register well.
Yeah, it's actually, audit planning is tough. If you are not in practice, you may not understand it sincerely. It's actually tough. So please go back to it. And as we review questions, we hope to look at 9 diets. If I start